Hey, Bowtie Nation, Joseph Hogue here, coming at you from sunny Playa del Carmen, Mexico here with some of my favorite investing creators at the Blossom Creator Routine. But I couldn't leave you hanging with the stock market news of this week. And Nation, what we just had was probably one of the most idiotic sell-offs I've seen in over 25 years of investing and more than 10 years as a professional analyst there on Wall Street. A lot of great stocks selling off, a mini crash that in its stupidity was only topped by the opportunity to buy the dip in some of these stocks. I'm going to show you why the stocks I'm buying on that stock crash, along with some of the stocks I'm watching this week, including big earnings reports for Robinhood, ticker HOOD, McDonald's, MCD, and Coinbase Global, ticker COIN. First, though, I want to thank all the people here at the Blossom Investing app, the first social investing app for investors by investor, for putting together this little Playa retreat that I so needed. If you haven't yet, look for the special invite link I'll leave in the description below. It's totally free to join, helps out the channel. I appreciate that. But you're also going to see real-time updates on my portfolio of the stocks I'm buying, as well as follow more than 500,000 investors to see what they're talking about in the social feed. On to the reason for that mini crash there last week, why it did rebound there on Friday, why we could continue to see stock market weakness here over the next weeks, because the reasoning here was the new agents released by Anthropic, by that AI model. And yes, software is hugely affected by these models. Basically what happened, Anthropic released some new agentic models that could do a lot of things, could do law, legal questions, could do a lot of software problems. And you can see the sell-off in software stocks here. Okay, so we've got NOW, which is ServiceNow, CRM, which is Salesforce, Datadog, Adobe, Intuit, all of those crashing over the last week, down as much as 15%, even on that rebound on Friday. But the fear is that a lot of that new AI model, those new AI agents can do the jobs that these companies are doing. So you see a lot of these. Workday down 6% for the week. Adobe and Intuit down about 9%. You had a 10% crash in CRM. Datadog down 13% and ServiceNow down almost 15% on that news. But the crash hit everything AI related, okay, which is the part that makes absolutely no sense. And folks, what you have to understand first here is that sometimes investors just want to get into hysterics and just want to sell, want a reason to take profits. And then of course the pundits, the people on TV, the people even here on YouTube have to create a reason to explain this so they know what they look like. They know they look like what they're talking about. But sometimes there's just no sense to the market, okay? The market is made up of people. People act the fool sometimes, and the collective market just wants a breather. So there isn't necessarily a reason for all this. It is just, the collective market wanting to sell off, wanting to cling to any particular reason to take profits on this. Now, against that sell-off, and really the news last week that we heard from Alphabet's Google, from Meta, from Amazon, from a lot of these hyperscaler big name tech companies, that leads me to believe that this was the most ridiculous sell-off and really a buying opportunity for these, is what we heard from these companies in terms of their capital expenditures, their capital investment that they're planning for this year. Okay, not only did Alphabet here, Google, beat its earnings and revenue, so they did very well over the last 3 months, but they announced they were going to double their capital spending for AI. Okay, double from last year. We can read through some of the notes here. Fourth quarter revenue jumped 18%, net income rising 30%. Okay, so that is leverage from revenue into profits. They were able to leverage revenue up from 18% into 30% profitability. The big news though here was this increase in capital expenditures that you see from 175 to 185 billion in 2026. That is up from 91 to 93 billion in 2025. On top of that, and one of the few stocks to actually jump on their earnings here, Meta shares were up over 10% on a stronger than expected revenue forecast. They also beat their revenue and their earnings. But what was important again here was their outlook for that capital spending, how that's going to feed into the AI story and the stocks that we're going to be buying. Okay, so if you see here, you can scroll down and they talk about their capital expenditures. Expects total expenses of 2026 to 162, 169 billion. Of that, the capital expenditures right here, up to about a midpoint of about 125 billion dollars spending on capex, and most of that is artificial intelligence. So spending about 120 billion dollars this year for artificial intelligence. That is 20% higher than Wall Street expected and double from what it spent in the last year. Final one here, and I'll show you which stocks this affects, why this is such a buying opportunity. But Amazon did see its shares sink on its earnings report, even though it beat earnings expectations, it beat revenue, but it was that spending, okay? Beat their earnings, but they announced $200 billion in spending, okay? They had a 10% of the company announced nearly 60% increase in its 2026 AI-related capital spending to $200 billion. Okay, behind this, Amazon Web Services, so that main cloud, that AI service that it runs, Amazon Web Services revenue grew 24%. Okay, that was slower than rivals Microsoft there and Google Cloud. Part of the reason why this shares were down on that earnings. But if you scroll down here and you get that whole story with what we're talking about, the capital spending, the expenditures into artificial intelligence. Okay, and a lot of this is playing into what is happening here, but it says the investor angst about spending increases for artificial intelligence. Microsoft, Meta, Apple's, Google, Amazon, and Oracle there. All together, just these 5 companies planning to spend over $700 billion this year in that AI data center build out, okay? Mostly building out those data centers, the infrastructure, the hardware and the software that goes into those data centers, that cloud compute to service or to deliver these AI services. And so when you hear about something like that and you put this news together, it makes no sense why AI infrastructure stocks crashed on this news during this week. Okay, SMCI, which I'll talk about later, reported revenue up 120% in the quarter, once again boosted its full year expectations. It was boosted its full year expectations to $40 billion in revenue. The stock was up 13%. You see that here. So SMCI up 13% on the day it reported, but then crashed down with the rest of this market during that little mini crash we saw in the week. You see here, SMCI up 13%, then down 13%, pretty much gained back 10% there on Friday's rebound. But then you've got some of the other ones, ANET, so Arista Networks, prime infrastructure networking stock there, down as much as 6%. Then you've got NVIDIA, the AI data center stock there, down as much as 7-8% there in the crash. And then AMD, okay, so NVIDIA's little counterpart there, the competitor, down as much as 22% in the crash, gaining some of that back there on Friday, but still way down on this news. And so again, folks, we get this idea that the market is trying to put a narrative, trying to put a reason or a story behind this crash, and that it is all related to this AI capital spending kind of idea and the software stocks and these new models by Anthropic. But it makes absolutely no sense if you look at those spending plans. Okay, $700 billion 1 year alone into that AI infrastructure that is going to directly benefit a lot of these infrastructure stocks, NVIDIA, AMD, Arista Networks, Broadcom, SMCI. Okay, that is money going directly into these companies. You know, last year, the big sell-off in AI stocks there towards the end of the year, it was all because we didn't know if that money was actually going to be there. Okay, all the $1.4 trillion that OpenAI has promised to spend on infrastructure, all the money Oracle has promised to spend on infrastructure, everybody was saying there's no way this money is going to be available and spent on that infrastructure build out. And so those stocks came down. Now we know that money is going to be available because we see these new software models by Anthropic that are able to do so much, and people are worried that they're going to replace a lot of these software companies. We know we are going to see that infrastructure building spending coming through. So now we need a new reason why the stocks are going to sell off, right? It just makes no sense. And these stocks will head higher as that money, as that $700 billion from this year alone hits a lot of those infrastructure stocks. As if that were not enough. And if that was all to the story, I might worry about it because of the economy, because of the weak jobs market. But we have a very strong economy coming as well. We can see here Trump's new tax law, that one big beautiful bill that was passed last year that is going to drive a lot of stimulus into the market. Okay, it has saved companies like Amazon billions of dollars. It's also going to boost earnings, but we can scroll through here and see how it's helping some of these large companies through that depreciation. It is actually on a cash basis for just Amazon. Company paid $2.8 billion in federal income taxes last year after paying more than $7 billion in the prior 2 years. So it reduced Amazon's tax bill for 2025. Okay, so for last year, that big beautiful bill reduced it by $5 billion. And if you look here, they actually increased their profit by 45%. Okay, so if they paid $7 billion in the year before, increased their profit by 45%, they probably should have been paying something closer to about $12 billion. Instead, their tax bill for last year's, they're filing this year, it's only going to be about $3 billion. So this has saved Amazon, one company, almost $9 billion in taxes just because the way that those tax law changes were pushed through into 2025 and really aids these companies. So what you're going to see a lot of this spending, this AI infrastructure spending is not going to hurt the earnings like it does a lot of times for these companies because they're going to be able to expense them all at once. It is going to be a big boost to the economy. Even more than that, though, the benefits for just everyday people in these tax law changes estimated to be a stimulus of more than $200 billion through refunds. Okay, all the companies out there, you work for a company, they withhold some of your paycheck for taxes. They were withholding too much because this budget bill got passed retroactively. So they collected too much for the taxes for last year. Refunds last year were approximately about $3,000 on average. This year, they could be $5,000, $6,000 on average. We see a lot of that economic strength in corporate earnings, okay? Companies reporting their Q4, so their last quarter, last 3 months of 2025 earnings there. 76% of companies in the S&P 500 have reported so far with an average earnings growth, average profit growth of 13%. Okay, it says here that in double digits, it would mark the 5th consecutive quarter of double-digit earnings growth. Even more than that, if we look at what the market expects earnings to be, okay, so these profits for companies through this year, we see record profit growth, 11% for the first quarter, 15% for the second quarter. When a lot of those tax law changes hit the economy, 15% for the third quarter. When a lot of the people that got those higher refunds start spending. For full year, expecting earnings to be up 14% on 7% revenue growth. That is very strong earnings and revenue growth that will support stocks, all stocks in the market, but especially these AI infrastructure companies that are getting all this money from this building. That is earnings, so economic strength plus stimulus coming, that is going to be a very healthy market. And as we've been doing all last year, looking at this AI supply chain and seeing where that money is going to be going, that $700 billion from just those 5 companies alone. So altogether, probably more than $1 trillion this year alone spent on AI infrastructure stocks. And this is it. These are the companies building that AI infrastructure. Okay, so in those memory companies, you got Micron, ticker MU. In the accelerators, Broadcom, ticker AVGO, probably one of the best positioned for this data center build out. Nobody other than maybe NVIDIA has as many components into a data center as Broadcom, ticker AVGO. They've got the accelerators. They've got the networking equipment and the software. They've got chips, TPUs for data centers. Marvell Technologies, ticker MRVL. Down here into the GPUs and the CPUs. Okay, so those main chips that drive that AI data compute. You've got NVIDIA, obviously. You've got AMD, very close to competition with them. Then within those chips have to go into a server. Okay, and you know my favorite, super microcomputer, ticker SMCI. You've also got Dell there and HPE, Hewlett Packard Enterprise, competing in those servers. They're going to get part of that $700 billion as well, but they are really held back by a lot of the retail retail equipment that they sell. Okay, then you go further into the users, the Metas, the OpenAI, the Google, Microsoft, Amazon, companies like that. Now, looking at some of the stocks I'm watching this week, going to be another huge week for earnings. A lot of these stocks that we're talking about in this infrastructure play, a lot of them also tied to the cryptocurrency markets that have been really hit hard over the last couple of weeks. First up here, Robinhood markets up 14% there in Friday's rebound. But you can see here, big drop from the $150 where it was trading at the peak there in October, almost half of where it was. We can see here the analyst estimates for the stock. We can see that it does report on February 10th there on Tuesday. We can see analyst estimates for revenue growth of 32% to $1.3 billion. That is less than the full year. Current year revenue expected at $53 billion or 53% to $4.5 billion as Robinhood really moves into other parts of the market, into prediction markets, further into cryptocurrency. Okay, so full year expected 53% revenue growth, 22% next year, up $2 per share for the current year. Just doing some back of the envelope math on that. If we do take that $4.5 billion in sales this year, market cap right now on Robinhood about $74.5 billion. So 74.5 divided by 4.5 billion in sales expected to report this year, that is about a 16.5 times on that price to sales valuation. Okay, so the price of the company, that market cap divided by their sales, their revenue, 16.5. You can see that is well below where it's traded at over the last 2 quarters, over the last 6 months, but they have traded as low as 9 times price to sales there just last year in 2 years ago in 2024. That means, this stock is not particularly cheap yet, even at that 16.5 times price to sales, even after that almost 50% drop there since October. But it is quite a bit lower than the 36 times or the 26 times people were paying for it there in September and June of last year. On a PE basis, expected to post $2 per share. $84 per share price divided by the expected earnings of $2, that would be about a 42 times price to earnings. And you can see that is lower than where it was last September and last June, but still quite a bit higher than it was here. So, I like Robinhood. I actually have an account on Robinhood and buy some crypto and some stocks through there. But even after this sell-off over the last three or 4 months, not particularly cheap here. Coinbase Global, ticker COIN, they're directly in the cryptocurrency markets, and you can see what an effect that cryptocurrency winter has had on it, down all the way from above $400 per share down to $165 per share. So more than a 50% sell-off. 39% down for the over the year last year, up 13% in that rebound though. And this is one that is getting quite a bit cheaper on some of those valuations that we'll look at. We can see here analyst estimates for the quarter expected to see a drop of 18% in its revenue for the last 3 months over the year before period. A lot of that was just that year before period was a very tough comparable. Okay, that was when President Trump was first coming in the 4th quarter of last year, or he had just been reelected, and people were thinking that cryptocurrency was going to rule the world under Trump, and everybody was getting on Coinbase. Coinbase made a lot of money over those 3 months. And now we're seeing the sell-off on that, but we do see for the full year and for the next year, they still are booking double-digit revenue growth. Expected 10% this year, expected 13% next year. $7.25 billion in sales this year, $7.7 per share in earnings this year. We can go to the statistics and see how that stacks up for valuations. So $7.25 billion in revenue expected if we take this market cap. Again, the price of all the shares in the market, that is $44.5 billion market cap divided by that $7.25 billion expected sales. That is a price to sales of 6 times, okay? Price of 6.1 times price to this year's expected sales. You can see that's right around where the current is. That is quite a bit lower than what investors have paid in the past, about half of what investors have paid there. 13 times price to sales valuation there in December of 2024, 13 times price to sales. If we take that $7.70, the expected earnings over the full year, we take that, the price, $165 per share right now, divided by that 7.7 is a price to earnings of 21 times. And again, you can see that is quite a bit lower than where it's traded at in the past. So relative to where it's traded at in the past, how much investors have been willing to pay for each dollar of earnings, how much investors have been paid for each dollar in sales, this is a relatively cheap stock. And if you believe in that cryptocurrency theme and that cryptocurrency development over the next few years, Coinbase would be an attractive play into its earnings here. Here you can see McDonald's, ticker MCD. It's going to be reporting its earnings on Wednesday there. Not doing too badly over the last week. Again, a lot of these consumer staples companies, some of the consumer discretionary retail names like McDonald's, not getting hit too bad because they have a little bit more stable cash flow, up 1.1% over the last day, over the Friday, up 3.8% there over the week. So providing some safety in that market last week, up 11% over the past year. Looking at their prior quarter's earnings reports, you can see management has not done a good job of managing those expectations, have missed earnings expectations in 3 of the last 4 quarters. So I believe any kind of a beat here will drive these shares higher, as the market just isn't expecting it. The market is not expecting McDonald's to be able to beat its earnings like most companies do when they report. But if we look at the expectations on those earnings, we can see earnings or revenue expected up 7% over the last quarter to $6.8 billion. That is well above the 3% expected for the full year, back to about 6% sales growth for the next year. So revenue growth of 3% for the full year, up to $26.7 billion, up to about $12.14 in earnings per share expected. If we look at those valuation estimates, if we take that $26.6 billion in sales, so $232.99 billion market cap, total value of all those shares in the market divided by the 26.6 billion in sales expected is about 8.75 times on a price to sales basis. So about what it's traded at over in the past. So not particularly cheap, not particularly expensive here, but again, this is one of those stocks with a little bit more stable cash flows than you see in a lot of those AI and tech stocks. A little bit safer there if you do believe we're in for more of that market volatility. Now with Arista Networks, ticker ANET, one of my favorite stocks in that infrastructure play. Here we're getting to see where that $700 billion in AI data center spending is going to be put. This networking hardware and software that Arista Networks makes. You can see it was up 6.8% there on that Friday's rebound, up 19% for the year, but you can see here down 3% for the full week as it sold off there, down as far as from $140 down to $125. So probably about 11-12% there at its worst in that sell-off last week. ANET reporting earnings there on Thursday, expected to post 23% sales growth to $2.4 billion, 76% earnings per share. They generally beat their expectations, so I'd expect them to be able to beat these numbers there. Revenue for the full year expected up 27%, so very strong double-digit revenue growth expected, $8.9 billion. Earnings up to almost $3 per share, $2.88 per share in earnings expected this year. I think they hit almost that $3 per share, just judging off of how well they usually beat their earnings expectations. Using those numbers to adjust our valuations here, if we take the $173 billion market cap divided by about $9 billion in sales expected this year, that is about 19 times price to sales measure. Okay, so you can see it's a little bit below where it's traded at, not quite as low as it's traded in the past year. It traded at 14 times price to sales, so not particularly cheap even after last week's sell-off. I would, if you want to jump in on some of these stocks that are still a little expensive, I would put maybe half of your investment in there now before earnings, see if they can beat their earnings expectations, but hold some back just in case we do see another dip over the next couple of months. Because again, Arista Networks in that prime networking bottleneck for AI data centers, going to be getting a lot of this money, a lot of that networking equipment money, along with AVGO, Broadcom, along with Astera Labs, ticker ALAB, which we're going to talk about next. Here, Astera Labs, ticker ALAB, really the darling in that networking infrastructure play with Arista Networks, with Broadcom. ALAB, ticker or Astera Labs, really the smaller company there, $28 billion market cap, up 62% over the last year. You can see here it rebounded 19% there on the Friday rebound. What was interesting here, over the last 5 days, up 12% total. So it did sell off along with a lot of those market stocks there in that Tuesday, Wednesday sell-off, but not quite by quite as much, and actually rose 12% on the week. You can see here, Astera Labs generally beat their earnings expectations over the last 4 quarters. Does report there on Tuesday, on February 10th. Expected to report 76% growth in its revenue, up to 51 cents per share for full year. Expected to double its revenue, 108% revenue growth there to $827 million. Earnings per share of $1.78 per share expected for the year. Now, of course, with that kind of growth, 108% revenue growth expected this year, you are not going to get this stock for a cheap price. If we take that market cap, $28.7 billion divided by the $827 million expected revenue, that is a price to sales of 34 times. Okay, you can see it's quite a bit lower than the current price to sales ratio, the valuation, and quite a bit lower than where investors have been paying for it in the past. It is not at its low point there, 20 times price to sales valuation there in March of last year on that sell-off. But again, any stock growing at 108% revenue growth per year, this is a growth company. This is that prime networking infrastructure play, the bottleneck in networking equipment that is going to these AI data centers. And I think this, along with Broadcom, along with Arista Networks, is going to get a lot of that $700 billion in infrastructure spending. And of course, the big news last week, the earnings report by Supermicro Computer, ticker SMCI, up 13% higher on that day as they reported $12.7 billion in revenue for that quarter. Revenue growth of 120% from the period before. But it wasn't just that 120% revenue boom. It wasn't just the upgrade to $40 billion in sales for the full year, or the fact that they really blew away their earnings expectations. It was the fact that that earnings report gives this stock the permission to go higher. Okay, there are so many bears, so much volatility in this stock. You can see that here over the last year, from $30 per share all the way up to 60, back and forth, up and down again. There's so much fear in this stock that a lot of investors are just scared to touch it. But the company is taking that server market share, okay? Those servers that have to be there in those data centers to hold all those NVIDIA and AMD GPUs. SMCI owns 22%, upwards of a third of that AI server market share. They are taking more, they are proving those bears wrong, and they are giving investors permission to buy the stock and send it back up. You can see after that 13% jump after the earnings on Tuesday, it did fall almost 13% the next day along with the rest of the market, but then rebounded to 11% higher there on Friday. Check out some of the best investing channels on YouTube with the links in the description, or join us all on Blossom with that special invite link to see in real time the stocks we're buying. Don't forget to join the Let's Talk Money community by tapping into that subscribe button and clicking the bell notification.